Most financial advisors have their eyes on 2025, but they might be missing the bigger picture. A hidden economic pattern, one that some economists claim has signaled major downturns for 200 years, is pointing to a major financial shock around 2026. If you're retired or getting close, the stakes don't get much higher. So here's the critical question. Is your nest egg protected, or is it a sitting duck? In this video, I'm going to show you 3 powerful strategies to build a financial fortress around your retirement savings, starting now. These are the steps that can give you security, so you can thrive while others are forced to panic. Before we get to the solutions, you need to understand what we're up against. This isn't about the day-to-day noise of the stock market. It's about something bigger, something structural. For decades, we were told to put our faith in a simple formula: work hard, save money, and invest in a diversified 60-40 portfolio, 60% in stocks and 40% in bonds. For generations, this was the bedrock of retirement planning, designed to be the ultimate shock absorber. The idea was simple. When stocks go down, bonds are supposed to go up, or at least hold steady, cushioning the blow. But in 2022, something broke. The machine seized up. Both stocks and bonds fell hard at the same time. Retirees who thought they were safe saw their supposedly balanced portfolios take a significant hit. That event was a massive wake-up call. It proved the old rules don't always apply, and that in a true systemic shock, the diversification you thought you had can vanish. Now add to this the warnings from economists like Fred Harrison, who has studied over 200 years of economic history. Harrison's work revolves around an 18.6-year property cycle, a pattern he claims has accurately predicted major downturns, including the 2008 crash. He argues that property and land values are the real drivers of the boom and bust cycle. His analysis suggests we are in the final speculative phase of this cycle, which he calls the winner's curse, projected to peak around 2026 before a severe correction. Other alternative theories, like the 50 to 60-year Kondratiev wave, also point to this period as the end of a major economic supercycle. Again, while these cycle theories are on the fringes of economic thought, they present a case built on historical patterns. The argument is that years of low interest rates and unprecedented money printing have created asset bubbles in everything from stocks to real estate. When these cycles turn, the correction can be swift and brutal. A serious concern is that governments and central banks, now saddled with historic levels of debt, may have limited firepower to fight the next crisis. This isn't a certainty, but it adds another layer of risk. For a retiree, this isn't some academic debate. It's a direct threat to your livelihood. And that brings us to the single greatest danger for anyone in or near retirement: sequence of returns risk. If you learn only one thing from this video, make it this. Sequence of returns risk is the financial term for having disastrously bad luck. It is the risk that the market tanks right when you start taking money out of your portfolio. Imagine 2 retirees, both starting with $1 million nest egg. They both plan to withdraw $50,000 a year to live on. Retiree A retires into a booming market. For the first few years, their portfolio actually grows, even while they're taking money out. Their $1 million base expands, giving them an even bigger cushion for the future. But retiree B's timing couldn't be worse. They retire, and in their very first year, the market crashes 30%. Even if the market completely recovers the next year, retiree B is in a deep, deep hole. Their smaller portfolio has far less capital to capture the rebound. That single early loss, made worse by the withdrawal, creates a permanent scar on their financial future. Over a 20 or 30-year retirement, this bad timing can mean the difference between a comfortable life and running out of money. This is the nightmare scenario. You did everything right. You saved for 40 years. But because of a crash in the first few years of your retirement, your entire plan gets thrown into chaos. The 60-40 portfolio that was supposed to protect you showed its cracks. The buy and hold strategy that works so well when you're 35 becomes a high-stakes gamble when you're 65 and need to pay your bills. This is why the 2026 warning, whether it ends up being a full-blown crash or just a severe correction, demands a different approach. You can't just hope for the best anymore. You need a deliberate plan to neutralize this threat. You need to build a financial fortress. And it all starts with changing how you think about your money. This isn't about panic. It's about preparation. Here are 3 powerful, actionable steps you can take to protect your retirement no matter what the market does. Step 1. Build a time-segmented fortress with the bucket strategy. The biggest mistake retirees make in a downturn is becoming forced sellers. They have to sell their growth assets, like stocks, at a loss just to cover monthly expenses. The bucket strategy is designed to stop that from ever happening. Instead of seeing your retirement savings as one giant pot of money, you're going to divide it into 3 distinct buckets, each with its own job and timeline. Bucket 1. The now bucket, 1 to 3 years of expenses. This is your first line of defense. This bucket has one job and one job only: absolute safety and liquidity. It should hold enough cash and cash-like investments to cover 1 to 3 years of your essential living expenses. Think about everything you have to pay for: mortgage or rent, property taxes, utilities, food, healthcare, and car payments. Add it all up for 1 year, then multiply it by 2 or 3. What goes in this bucket? Cash, kept in a high-yield savings account; money market funds, highly liquid and stable; short-term treasury bills, backed by the full faith and credit of the U.S. government. The goal here is not growth, it's preservation. This bucket is your financial moat. If a crash happens, you won't touch your other investments. You'll calmly live off this money for the next 1, 2, or even 3 years, giving your growth investments precious time to recover. This simple act provides an incredible psychological benefit. It lets you ride out the storm without making emotional, fear-driven decisions. Bucket 2. The soon bucket. 4 to 10 years of expenses. This bucket is your bridge. Its purpose is to generate income and modest growth with a focus on stability. Over time, it will be used to refill bucket 1. This bucket holds investments that are more conservative than stocks, but still offer some potential return. What goes in this bucket? High-quality bonds, investment-grade corporate or municipal bonds, dividend-paying stocks, shares in stable blue-chip companies with a long history of paying out dividends, income-focused funds, mutual funds or ETFs designed to generate a steady stream of income, buffered ETFs. These are modern tools built to give you stock market exposure with built-in downside protection, which can limit potential losses in exchange for capping some of the upside. This bucket is designed to handle moderate volatility. During a market downturn, the income from these assets can continue to flow. As things improve, you can sell some of the appreciated assets here to top off bucket 1. This system ensures your now bucket never runs dry. Bucket 3, the later bucket, 10+ years of expenses. This is your engine for long-term growth. This bucket holds the money you won't need for at least a decade. Because you have such a long time horizon, this is where you can take on more risk to chase the higher returns you need to outpace inflation and make sure your money lasts a lifetime. What goes in this bucket? Equities. A diversified mix of domestic and international stock market index funds. Real estate. This could be through real estate investment trusts, REITs. Alternative investments. Depending on your personal risk tolerance, this could include other assets geared for growth. During a crash, this bucket will likely take the biggest hit. But because buckets 1 and 2 are protecting you, you won't be forced to sell anything from here at a loss. You can give it the time it needs, 5, 7, or even 10 years, to recover and grow, which historically it has always done. By setting up your money this way, you create a fortress. The walls are your cash reserves, the guards are your income-producing assets, and the engine of your kingdom, your growth assets, is protected deep inside, free to do its work for the long haul. Step 2. Install a flexible defense with dynamic spending. The second cornerstone of your fortress is flexibility. The old retirement model, often called the 4% rule, was way too rigid. It said you should take out 4% of your portfolio in year 1 of retirement, and then adjust that dollar amount for inflation every year after, no matter what the market was doing. As we saw with the sequence of returns risk nightmare, that rigid approach is incredibly dangerous in a down market. Withdrawing a fixed amount from a shrinking portfolio is a recipe for running out of money. The solution is dynamic spending. It simply means you adjust your withdrawals based on how the market is doing. You create a flexible system with preset guardrails that guide your decisions and take the emotion out of it. Here's a simple way it can work. 1. Establish your base, withdrawal. You start with a target withdrawal rate, let's say 4% of your portfolio. 2. Set your guardrails. You then decide on an upper and lower limit for your spending. For instance, you might decide you all never increase your withdrawal by more than 5% in a great year. Adjust annually. Each year, you look at how your portfolio performed. If the market had a strong year, you give yourself a raise. You might increase your withdrawal by inflation, plus a little extra, as long as it doesn't go past your ceiling. This lets you enjoy the good times. If the market had a down year, you tighten your belt, just slightly. You could skip the inflation adjustment for that year, or reduce your withdrawals by a small, pre-planned percentage. Since Bucket 1 already covers your essentials, this reduction usually comes from discretionary spending, things like extra travel, fancy dinners, or a big new purchase. This flexible approach is incredibly powerful. Research shows that making small, permanent adjustments during downturns is far more effective at protecting a portfolio than making huge, temporary cuts. By pulling back just a little during bad years, you dramatically weaken the threat of sequence of returns risk and give your portfolio a much better chance to bounce back. Step 3. Anchor your fortress with the power of zero. The final step is to build a foundation of absolute stability for a part of your portfolio. This is about embracing the power of zero. It means ensuring a portion of your retirement savings is designed to be protected from market downturns. While Bucket 1 gives you liquidity, it doesn't offer much growth. Bucket 3 gives you growth, but with risk. The power of zero often comes from a specific type of financial tool designed to offer both principal protection and potential for growth. One of the most common tools for this is a fixed-indexed annuity, FIA. Now, annuities can be complex and have a mixed reputation, often due to high fees or confusing terms in older products. However, modern, well-structured FIAs can be a powerful part of a retirement fortress because they are built to eliminate downside market risk. Here's how an FIA generally works. 1. Principal protection. You place a sum of money with an insurance company. In return, they guarantee that your principal is protected from index losses. If the market crashes, your account value doesn't go down. You get a 0% return for that period, but you don't lose a penny of your principal. This is the power of zero. In a year the S&P 500 is down 20%, your FIA balance stays flat. Zero is your hero. 2. Indexed growth potential. When the market goes up, you get to share in the gains. Your interest is linked to the performance of a market index, like the S&P 500. However, you don't get all of the upside. The insurance company limits your potential gains using things like caps, a maximum rate you can earn, or participation rates, the percentage of the index's gain you get. For example, if the S&P 500 goes up 10% and your FIA has a 7% cap, you'd be credited with 7% for that year. If the index goes up 25%, you still get 7%. But if the index goes down 20%, you get 0%. You lose nothing. Why is this so important for a retiree? An FIA helps neutralize sequence of returns risk for the money inside it. By placing a portion of your soon bucket or even long-term savings into a product like this, you build a stable floor under your retirement plan. But it's crucial to know they have risks and limitations. The guarantees are backed by the financial strength of the issuing insurance company, and some products have high fees or long surrender periods where you can't access your money without a penalty. It's vital to work with a trusted financial professional to find a transparent product that fits your needs. But as a strategic tool, incorporating an asset with the power of zero can be the final element that makes your financial fortress truly resilient. So, what's the bottom line? The warnings for the coming years are on the horizon. While no one can predict the future, the risks of relying on outdated, rigid strategies are clear. But you don't have to be a victim of the next market cycle. You can take control. First, you build your fortress with the Maawas bucket strategy. Secure your immediate needs, build a stable bridge for the medium term, and let your growth engine run for the long term. This ensures you're never a forced seller in a down market. Second, You install a flexible defense with dynamic spending. You ditch the rigid 4% rule and adapt to market conditions, protecting your portfolio when it's most vulnerable. And third, you anchor it all with the power of zero. You allocate a portion of your savings to a strategy that offers principal protection, guaranteeing that part of your nest egg is shielded from a crash. By implementing these 3 steps, you change the game. You move from a position of anxiety and fear to one of strength and control. You create a retirement plan that's not just built for the good times, but fortified for the storms. The time to prepare is now. Don't wait until the storm hits. I invite you to continue delving deeper into the world of finance and business. Here is another video and a playlist, one step at a time.